there's a few ways you can reduce your taxes on investments, and you should be familiar with all of them. The first one is to use retirement accounts. If you use tax-protected accounts, it dramatically reduces the amount of taxes you pay on your investments. Basically, you can buy and sell, no capital gains taxes. You don't have to pay taxes on any dividends or other distributions from the investments as you go along. And you get a tax break up front for a tax-deferred account. If it's a tax-free account, the money is never taxed as it grows. For most people using tax-deferred accounts, they will be an arbitrage between their tax rate at the time they are contributing the money and the tax rate at which that money is effectively withdrawn from the account later. It is just a great way to reduce your investment-related taxes. So you got to max those out. Aside from the tax benefits, in almost every state, you get excellent asset protection for those accounts. Your 401k is protected federally. In most states, your IRAs are also protected, receive at least some protection. You should be aware of your state asset protection laws, of course, in that regard. But it is a very easy asset protection strategy to just max out your retirement accounts. All right, the second way you can reduce your investment-related taxes is buying and holding tax-efficient investments. Okay. If you're not churning your investments, you're not having to pay short-term capital gains taxes. You're not even having to pay long-term capital gains taxes because you are holding the investment. It helps if the investment doesn't spit off a lot of income. That makes it more tax efficient. If it does spit off income, hopefully that income is taxed at a lower rate. In real estate property, it may be covered by depreciation. In the stock realm, qualified dividends. If you hold the stock or the fund for at least 60 days around the time of the dividend, then it should be qualified and qualify for lower qualified dividend and long-term capital gains rates. Now, those rates are likely to go up with the tax bill currently in Congress. Maybe it's even passed by the time you hear this. I'm recording this on October 21st, but it doesn't run till November 18th. But even so, even with the proposed changes, it's going to be significantly less than your ordinary income tax rates. All right, the third way you can reduce your investment-related taxes is by using municipal bonds. If you are investing in bonds in your taxable account, and you're a high earner, like most of you listening to this podcast, you should give serious consideration to using municipal bonds for at least some of that bond allocation. The interest from municipal bonds is tax-free. Okay? If they're bonds from your state, it may be state and local tax-free as well. And so that helps it to be even more tax efficient. Now, obviously, the yields on those are lower than they would be on a taxable bond. But if you're in a high bracket, generally you come out ahead using a municipal bond or a municipal bond fund. So I do have to invest in bonds in my taxable account. And so what do I use? I use the Vanguard Intermediate Municipal Bond Fund. And that's treated us well over the years. All right, number 4, what can you do? You can tax loss harvest. Okay, this is where you have a loss with something you bought, usually something you bought in the few months previously, maybe a year or two previously, and the value goes down. Well, there's no reason to hold on to a losing investment in a taxable account. At a minimum, you should swap it for a very similar investment, but not, in the words of the IRS, substantially identical. So a good example is swapping from a total stock market fund to an S&P 500 fund, right? These are substantially different investments, but the correlation between them is like 0.99. So when you do that, you book that loss and you can use it on your taxes. It can offset up to $3,000 a year of ordinary income, and it can be carried forward indefinitely. And it can offset an unlimited amount of capital gains. And so if you expect to have some capital gains in the future, it's great to book these losses as you go along. All right, the fifth one is to take advantage of depreciation. This is particularly important for the real estate investors out there. Using depreciation, you can often offset the entire taxable income of a real estate property or a fund or syndication, however you've chosen to invest in real estate. And so it's pretty cool to get $10,000 a year in income and get no tax bill at all, or maybe only pay taxes on $2,000 of it. And that's as a result of depreciation. Even when that depreciation is recaptured, if and when that property is sold, it's recaptured at a lower tax rate than what you got up front. And so it's a great deal Take advantage of it. Finally, a great benefit and a good way to get rid of appreciated shares, whether it's stocks or whether it's funds or ETFs, is to donate them. If you're going to give to charity anyway, if you've owned these shares for at least a year and they've appreciated, donate the shares instead of cash. And then you can basically flush those capital gains out of your portfolio. And you can buy those shares back the same day or the next day. There's no 30-day wait period like with tax loss harvesting. You can do it right away. So there's no reason not to use that opportunity to flush capital gains out of your portfolio. And you should also take advantage of the step up in basis at death. It looks like there's been some talk in Congress about changing this, but it doesn't sound like it's actually going to change in this tax bill coming up. Obviously, that's subject to change until the bill becomes law. But with the step up in basis at death, basically your heirs, their tax basis on the investments they inherit from you is the same as though they had bought them on the day of your death. And so that is a great way to save on a lot of capital gains taxes for them. So those are the general ways in which you can save money on investment-related taxes.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.